let's begin the show by putting the spotlight then on a fintech company, Niro, that has recently raised close to $11 million or 90 crore rupees. This is in a funding round. It's a mix of equity and debt from a clutch of investors. We've got Aditya Kumar joining in. He's the founder and CEO at Niro. Thank you so much for taking time out. So let's talk about the latest fundraise, the Series A round that you have raised, and who are some of the investors? Who is the debt capital as well been funded by, and what's the total?
Hi, Avanne. Thanks a lot for having me. So as you correctly said, we did an $11 million raise. $8.5 million of that was equity. $2.5 million was venture debt. The equity investment came from Elevar Equity, our existing investors, as well as a consortium of Japanese investors led by GMO Venture Partners and Rebright Partners. The venture debt was funded by Innovan Capital, one of the largest venture debt investors in the country.
So previously as well, there was a fundraise in the month of October. That was the seed funding round. So walk us through, the total funds that have been raised. Any picture that you can share with us as well when it comes to valuations of Niro?
Sure. So as you're correct, we raised our seed round, which was a $3.5 million round in October of 2021. The A round, which was announced, was in April of 2023. So approximately 18 months lapse between the two rounds. Outside of that, we haven't raised any capital. So both the equity rounds put together bring us to about $12 million of equity capital, in addition to the $2.5 million of venture debt, which was recently raised.
All right. Moving right on then, let's also discuss what you will be using these funds for. Are you looking to expand your footprint? What's the outlook in terms of your product offerings? Will there be a lot of focus on tech?
So just to put it into context, since we raised our seed round back in October of 2021, we launched our business, which is an embedded credit business that enables large consumer internet platforms to become and be fintechs through primarily competitive and frictionless credit distribution. Since our launch in January of 2022, in 16 months, the company today originates 60 crore rupees of loans a month, has cumulatively originated over 300 crores of loans in 16 months, and is at a $4 million annualized revenue run rate. With the funds that we've raised over the next 12 to 15 months, the aspiration is to grow from 60 crore rupees of monthly originations a month to 150 crores of monthly originations, to grow from a 300 crore AUM to close to a 850 crore AUM, and to grow from $4 million annualized revenue run rate to almost $12 million of annualized revenue run rate. In terms of specific areas that the fund will get deployed into, product and technology are front and center, in addition to risk management and our analytics and data capabilities.
What's the outlook then in terms of your incremental revenues that you are generating at the current juncture? Are you profitable?
We are profitable at a unit level, which means that for every loan that we fund, both in terms of the acquisition costs, our operating expenses, as well as any other expenses associated with the origination of that loan, we make money on the very first loan that we originate. Profitability will come in over the course of the next 18 to 20 months as we get to the desired scale that we plan to, primarily using the funds that have been raised as part of our A round.
I just want to understand, given that there are a lot of other players as well within the fintech space, are you worried about competition really heating up, and how are you looking to retain market share?
That's a great question. So I think, look, competition is a function of two sides of an equation, which are how large is the market and how many players are there aggressively going after that market. As it turns out, in the sort of consumer lending fintech ecosystem and or the embedded finance ecosystem, there are actually a medium number of players that are going after a relatively small market of high income prime consumers. If you look at the overall market in terms of where demand exists for consumer credit across income spectrums, across the type of employment that people have, across various geographies, across various use cases, there are very, very, very large and very fast growing segments of the market that are either unserved or, if not unserved, underserved. So I think competition exists in certain areas of the market. It's not something that's, is not something that we worry about today, at least. And especially in terms of the large underserved and unserved parts of the market that Niro is able to cater to through embedded distribution.
So what's the game plan then down the line in terms of the kind of partnerships that you currently have, and who are some of the other partners that you're looking to onboard?
So we're a two-sided marketplace, which means we have partners on the demand side, which are our consumer internet platforms that we work with, as well as partners on the supply side, which are the lenders that we work with. On the demand side, we currently work with platforms like Snapdeal, Housing, Quicker, to name a few. And on the supply side, we work with lenders such as Muthoot Finance, L&T Finance, IDFC First Bank, and a couple of others. Today, we have about a dozen partners combined across the supply and demand sides of our ecosystem. The plan over the next 12 to 15 months is to take that to both larger consumer internet platforms on the demand side, as well as larger balance sheet partners on the supply side. That number of 12 across supply and demand would likely grow to about 25 over the course of the next 12 to 15 months.
So since your launch, how much worth of loans have you dispersed across how many cities? And if you could just walk us through the overall run rate.
So we have since launch disbursed over 300 crores worth of loans. These have been disbursed across 14,000 pin codes in India. And we have grown from zero in January of 2022 to a 60 crore monthly origination run rate in April of 2023. And this is pegged to grow to about 150 crores a month within 12 months from now.
All right. And what's the long-term game plan? If you could just walk us through what you're penciling in for the company.
So the idea is to get to $1 billion book in the next 24 to 30 months from now. That would make us in the construct of our current business model and with a few additional product enhancements that we have planned for the next 18 months. That should render the company very profitable. So we should be generating a significant amount of surplus at that point from a PBT point of view. Assuming we can achieve that, then I think the world is our oyster. And given the sort of expectations on demographic dividend, given what's happening in the overall sort of macro, and with the explosion of the Indian middle class, I think there is significant room for Niro to become an extremely valuable player with time to come.
Let you go on that note. Thanks so much for joining us and giving us a view on how business is shaping up.
Thank you.
Let's put the spotlight then on Celesta Capital. The company is a deep tech-focused US venture capital firm, and they want to double down on their investments in India. With already investments in the likes of Arzu, Rizzle, as well as Helify, we connect then with Aditya Kumar, the managing partner at Celesta Capital, to discuss their India plans and lots more. Thank you so much for taking time out. To begin with, you're planning recently to raise a cumulative India portfolio from the current 15% to about 25% or higher. So what will be the total corpus that will be raised across funds and the India exposure?
We have about $1.1 billion under management in total. And as we go forward, we expect to have an increased focus on India. So we're not looking at specific numbers, but we're looking at definitely increasing our focus in India, where we have a number of very great opportunities. And you mentioned a number of them. I should also add one more, which is IdeaForge, which is registered to go public. So we think that there's going to be plenty of exciting opportunities here, which warrants a much greater focus from Celesta on India. Now, especially as we look at technology, we think that we are going to see a larger number of deep technology companies coming from India. We've seen quite a few, and these are in the areas of semiconductors. These are in some areas where you have high technology and biotechnology coming together, what we call bioconvergence. We see opportunities in applying technologies like IoT for the transformation of various sectors like agriculture and healthcare. So we are just looking at a very exciting range of opportunities, which warrants that we dedicate more focus and resources on the opportunities in India.
Yeah, so can you give us a little bit more of a flavor as to currently what the total corpus has been that has been raised across funds, and you recently as well closed the fourth round. How much was that worth?
So we have raised four Celesta funds in the US. The total of that is 1.1 billion. And, in this business, every 2 years, you go out and you raise a large amount of money, which you then deploy over the following 5 years. So we, in the process of doing that right now, we are certainly seeing that India will be a big component of what we do going forward.
Okay, so clearly you're talking about doubling down on India and a lot of potential over here. Let's understand what exactly the average check size is going to be and what are the companies that are currently as part of Celesta Capital's portfolio in India.
So we are an early to mid-stage fund. So the check size initially can be anywhere from 3 to 5 million, and over the period of our investment, it can go up to 10 or 15 million, which happens over a period of a number of years. And that will continue. You mentioned some of the companies that were active in India, Idea Forge. I'd like to call out another company called Stellapps, which is in the agriculture space in the area of milk production. You mentioned Arzu in the retail space, Connect and Heal, which is in the healthcare space. We have a number of such brick and boat in the housing space, and housing is almost a limitless market in India. So we are covering high potential, large sectors on the one hand, where there's going to be transformation, and other areas where there's going to be very deep technology, which could include manufacturing, semiconductor design, and so forth. And what distinguishes us is our focus on deep technology. We are not doing too many, we are hardly doing any consumer plays, so to speak. We're really focused on areas where there is a very, very strong technology moat, where there's complicated design, where there's technology that is not easily replicable. And we feel that there's plenty of such talent in India to play in those areas. An area that's going to come up for even more attention is fabless semiconductors. So that's another area where we are going to play in, we believe. We've had some successes already in that space.
Okay, so give us an outlook, given that you're so closely tracking the space, talking about deep tech, AI, IoT. Give us an outlook as to what exactly is happening in the sector. Where does India stand?
There's an increasing focus on India's capabilities in technology. I don't know if you've been following the focus on what they were called critical and emerging technologies. So the national security advisors of the US and India got together a couple of months ago and identified a number of areas, including in telecommunications, semiconductors, where there are certain technologies that are critical to the progress of India and the US, in fact, globally. And these are areas where there can be a lot of synergy between what can be done in India and what can be done in the US. So we see a strong connection, a strong high bandwidth connection between the US and India in advancing in these technologies. And those span a number of areas, but certainly fabless semiconductors is a key one. Going forward, telecommunications will be another one. And if we were to look further down, we certainly see a lot of potential in what we call bioconvergence.
But at the moment, in India, we are also seeing a funding winter play out. There are concerns looming large with respect to global recessionary fears. There has been a mass exodus of employees and layoffs. So it is a tough environment. At a time like this, how are you looking at, the startup landscape space? Do you think that these problems that are especially prevalent within the tech space are here to stay? Would you describe it as a cleansing of the system? Would you say that the environment is going to remain still more tough for the year ahead?
Well, I'd make a number of observations. First of all, I lived in Silicon Valley for 4 decades. So I've seen many of these ups and downs going, every decade we have some kind of an up and down situation. But one thing that I'd say I and my colleagues have observed is that some of the best companies are founded and built in these trying situations. So in some sense, the funding goes to the most deserving. The most deserving are often the ones who are the most resilient and will stick with their belief and vision during hard times. So in many ways, this is the right time to be investing in founders and companies that have a vision to do something really different and have the commitment to stay through it. I think the best ones are going to be chosen at this time. And by the time they've got their product and their solutions out, we'll be seeing a better picture globally. Now, I must say, while globally there are all these concerns about a slowdown, etc., we don't really see that much in India. In India, I must say see a lot more optimism. The growth seems to be more robust. So to some extent, India seems to be not afflicted as much by what we're seeing elsewhere in the world. That's one more reason to be focusing on investing in India and building some great companies out of India at this time.
And what are the other reasons? Why is it that India is looking so appealing at a time like this? Why are you looking to significantly increase exposure to this region?
Talent. Number one reason is talent, Indian talent. Remember, all large technology companies globally have very large establishments in India. Many of them have their largest employee populations in India. And they're not doing, a lot of them have some back office operations, but the important thing to remember is that a lot of great design work is being done in India. There are many teams that are global, that are linked with India. Often product development is led out of India. So the talent is here. This talent will play globally as they're doing today within the confines of large global companies. Many of those engineers will decide, hey, I can go out and build this for myself. And they will assemble a team and write a business plan, raise money, and build enterprises. So we are seeing that, and we'll see more of that. So the answer to your question is the talents that we have here in India.
Recently we've seen a number of valuation resets or markdowns, if you will. A lot of companies, Ola, Swiggy, etc., have fallen prey to this. Do you believe that even when it comes to the listed entities and even across a lot of these new age fintech companies, that now there will be a bit of a relook? Has the investment outlook now changed with this valuation reset?
But money is tighter, so that will be reflected in valuation readjustments. It's only natural. But most importantly, be reflected in greater efficiencies, in making money go further, in ensuring that the money that is spent towards value creation. So I think we'll see a lot more efficiency, actually a lot more increased capital efficiency as a result of the funding situation. Just like higher valuations happen when there's froth in the market, valuation write-downs do happen when markets get tighter. That's par for the course.
Right, thanks for giving us that clarity, Mr. Kumar, and good to know that India is looking very attractive as an investment opportunity. Good to have you on Startup Central.
Yeah, good to be here. Thank you.
Let's put the spotlight then on Swiggy, and yet again you've got a US-based asset management firm, Baron Capital, which has reduced their valuation by another 10% to about $6.3 billion. My colleague Sharad Dubey joins in with the details. Sharad?
Well, yes, in focus we are having Swiggy, and two important things are plaguing the company. The first one is, of course, the valuation markdowns coming by marquee investors, and the second thing is there has been key exits announced of late, and of course recently CTO's resignation was also there. But the main news is that there has been a second markdown coming in the company's valuation, and this is coming in by Baron Capital. Apart from this, it is said that Senior VP Anuj Rathi, who's heading the growth and the revenue segment, is likely to leave the company. Now, looking at the total layoffs happening in the company, that's roughly 380 individuals so far in this layoff season. And the important thing we focus on is the valuations part. Now, looking at the numbers, of course, we can see there has been a second markdown coming from Invesco, roughly 49% from the last markdown. That is roughly, you could say, almost $5.5 billion, and also a second markdown coming from Brandon Capital, which is almost translating into a current valuation of $6.4 billion. Now let me tell you, the peak valuations of Swiggy stood at $10.5 billion in October 2022. So we can see important markdowns are happening, especially on the year end in the March part. Now, apart from the valuations itself, there is a certain sliver of hope, and that is the path to profitability for the IPOs and the startups. And recently, CEO Sriharsha Majeti, he stated that the food delivery business has become profitable in the March 2023. Apart from this, he also stated that the company is on track to hit the contribution neutrality for Instamart in the coming weeks. And this adjustment, if you are talking about the profitability, this doesn't include the ESOP cost adjustment, but it factors in all the corporate costs. So to put it in a simpler manner, food delivery business would turn profitable in the March 2023 numbers. But going ahead, what are the important triggers for Swiggy? And of course, the important issues will be addressed going ahead, but they are planning for an IPO in the month of September next year, in the year 2024, and they plan to sell their kitchen service business, and that is expected to come in at a swap agreement, and they are expected to raise roughly $40 million from it. So the company is focusing on reducing cost, monetization, but there is a plague of valuation markdowns happening in the company and also senior level exits.
Well, with the crisis of credibility looming large over the finfluencers, my colleague Bhavya takes a deep dive into the world of finfluencers and how they manage to make money, the regulations that have been put, and how you need to beware.
Influencers, a surging industry of people who market financial products on behalf of other firms, risk being pushed to the edge by the regulators as they air concerns about the threat of influencers on investors via these carefully crafted campaigns on online and social media platforms. Finfluencers rake the moolah in their heyday, but will the good times last longer?
1 year ago, there was like, let's say 10, 15, 20 finance influencers that you can talk about, right? Today, there are like 100, 200, 500 also creators. So you're very confused with who to work with, who to not. And if one creator is not working with you for a particular budget, brands are happy to drop that creator for an alternative.
Now, how much of the revenue comes from which source? So the top 5% of the financial content creators earn 40% of their revenue from online or academic courses and workshops that they build for their audiences. The rest 30% comes from affiliate collaborations with brokerage firms like Zerodha, Upstocks and much more. And then the remaining 30% comes equally from brand collaborations and AdSense on YouTube. So which platform leaves the longest to help influencers reach their audience? Let's take a quick look. So when we talk about earnings via marketing courses and workshops, that comes majorly from LinkedIn and Twitter. But if we look at the earnings via affiliate collaboration with these brokerage firms, then that comes majorly from Instagram as well as YouTube. Now here's how the affiliate collaboration works. So how this works is influencer posts videos on equity trading, provides broker a link with the video, and the viewers can open account, become investors and trade through that link. Then broker gets a commission based on that and pays influencer for the services by brokerage.
We are working with the ministry concerned, the MeitY ministry, and with the Reserve Bank, and clamping down on them like never before, so that we don't get those Ponzi apps taking away hard-earned money. So social influencers, fin-influential influencers are all out there, but a very strong sense of caution is required in each one of us to make sure that we do double-checking, counter-checking, talking with people. Don't go as a flock into something because somebody else has gone and you also go without doing your due diligence. We have to be careful. It's our hard-worked money.
Even though the influencer market in India is growing more and more with more creators joining the force, they're not being able to earn as much as the top 5% of the market does. More and more regulations coming in play for influencers and startups facing a funding crunch. The income for the 95% of influencers have gone down.
With that, we're completely timed out on this edition of the show. Do remember, you can keep connected with us on SUC at etnow.tv or simply on my Twitter handle. Catch you same time tomorrow. Thanks for watching.